Hello, Colorado, and welcome to Nolan Financial Radio. I'm your host, Chris McKinney. I'm glad you're here today because we're about to dig into a topic that affects everybody. And I've been getting this question a lot, so I thought we should talk about it. It's how you put your money into the market. Do you use ETFs and mutual funds? What is the difference? What are they? Why are there differences? So now I know what some of you are thinking. That sounds like a technical financial topic. Something for the Wall Street people, something that doesn't really affect me. But here's what you need to understand before we go too further. The choice between these two investment structures, ETFs and mutual funds, is not just a Wall Street decision. It's a decision that can quietly cost you thousands of dollars in taxes every single year. And for many listeners, it may already be doing that. So we're going to cover what ETFs and mutual funds actually are, how they differ, what the most current 2026 research tells us about their tax implications, and most importantly, what questions should you be asking your financial advisor right now. I can tell you that we have some ETFs in our office, and so if after you hear about this, you're interested in getting into more mutual funds or more ETFs, we can help you do both. So here's a number I want you to hold in your mind for the next 30 minutes, 52. That is percentage of mutual funds that paid capital gains distribution to investors last year. And most of the investors had no idea it was coming. They didn't sell a single share. They didn't make a single decision, but they still got a tax bill anyway. So we're going to explain exactly why that happens. So, and maybe what you can do about it. Let's start from the beginning. If you've been investing for any length of time, you almost certainly own either a mutual fund or an exchange traded fund with an ETF. And there's a good chance you own both without thinking too much about which is which. Let's fix that right now. Mutual fund is a pooled investment vehicle. You and thousands of other investors contribute money into a common fund, and a professional manager or a team of managers invest that money according to the fund's stated objective. Maybe it's growth stocks, maybe it's bonds, maybe it's a blend of both. Whatever the perspective for that mutual fund says they have to do, they do. So here's the key structural detail. When you buy or sell shares of a mutual fund, you transact directly with the fund company itself. You can only do that once a day after the market closes at a price called the net asset value, the NAV, which is calculated at the end of the trading day. Mutual funds have been the backbone of American retirement savings for decades. They're great. They gave us access to diversity without having to pay for a broker, maybe pay all the brokerage fees, all the transaction fees that go on into doing that. So they're great. Your 401k is probably invested in a mutual fund. Maybe they call it a lifestyle fund or a target date fund, something like that. So we've seen a lot of those in our office. They offer professional management, broad diversification, and the ability to set up automatic contributions easily. It's a good advantage for people building wealth through regular payroll deductions. Okay, so what is an ETF? An exchange traded fund, an ETF, is at its core a mutual fund that trades on the stock exchange. So think of it this way. It's a traditional mutual fund like buying a house through a real estate agent. That's what a traditional mutual fund is like. An ETF is like buying a house on the open market. The underlying asset is similar. The mechanism of purchase is different. Now, we have ETFs in our office, and they're exactly the same as buying a mutual fund from once you come into our office. So it's kind of changed a little bit as ETFs evolve, but ETFs do something different than mutual funds. They trade throughout the day, just like individual stocks. You can buy it something in the morning and sell it in that afternoon. So their price fluctuates in real time. You purchase them through a brokerage account. Now, like I said, things are changing with ETFs. You can get an ETF through your financial advisor like me now. You don't have to go through a brokerage account. You can go through a registered investment advisory. Okay, so it's kind of new within the last few years that this is more available. So in recent years, ETFs has really exploded because uh, it's just a great way to do trading. It doesn't have the overhead of the mutual fund companies. So ETFs took in over $1.5 trillion in new investment money in 2025 alone. That's an all-time record. At the same time, mutual funds saw their second largest annual outflow ever, with $692 billion leaving those structures last year. Now, some of that's due to different things. Some people are selling out of their mutual funds and moving and buying their dream house and leaving. So, why all these things are happening is pretty complex. But more than 1,000 new ETFs were launched in 2025 alone. The industry has expanded so dramatically that today you can find an ETF for almost any strategy, sector, or asset class imaginable. So, why the shift? Why are so many investors moving money from mutual funds into ETFs? Two big reasons: cost and taxes. And today we're going to go deep on both with particular attention to taxes, because this is where the conversation gets genuinely eye-opening. Now, the taxes are really outside of retirement accounts, right? So it's not, there's no taxable income in qualified accounts, some kind of qualification you have with the IRS. So we're going to talk, it's more like in an individual account. So we're going to talk about what they have in common before we get into the differences. So it's worth acknowledging that Kathy Keller, the head of indexed equity products at Vanguard, recently said to Fox Business, when investors compare ETFs and mutual funds, it's important to start with what they have in common. So both are professionally managed portfolios. Both provide diversified exposure to stocks or bonds. Both allow you to access a wide range of markets without picking individual securities. In that sense, they are more alike than different. Here are the differences, and they do matter. It comes down to structure, how they trade, how do they handle investor redemptions, how those structural differences create dramatically different tax outcomes. So you've been hearing about the differences between ETFs and mutual funds, and the tax implications are significant. But here's a bigger question: do you actually know how your portfolio is structured and whether it's costing you money every April? At Nolan Financial Partners, we sit down with people just like you for a complimentary portfolio review. No sales pitch, no obligation, just a clear, honest look at where you stand and whether your current investment structure is costing you more than it should. So give us a call at 719-210-4242. That's 719-210-4242, or visit us, NolanFinancialPartners.com. You can schedule our free appointment. Our advisors are ready to help. Okay. All righty. Now we get to the heart of today's show. I'm excited because everything we just covered, the mechanics, the trading differences, the growth of ETFs, all of it becomes much more significant when you understand the tax implications. Let me paint a picture. You own shares in a mutual fund. You've had them for years. You haven't sold anything. You've been patiently holding, letting your investment grow. And then December rolls around and you receive a notice in the mail, a capital gains distribution, a taxable income, a bill from the IRS, even though you didn't do a single thing. Sound familiar? If so, you're not alone. When I was in my mid-20s, I had money in a mutual fund, and the mutual fund was doing great. I was really enjoying the growth on the mutual fund. But then it kicked out a $6,000 capital gain in 1 year. I was a lieutenant in the Air Force at the time, and so I didn't have a lot of money to pay the income tax on that kind of investment. So I actually had to sell some shares to help pay for the the capital gains on that bill, right? So the taxes, that was an enormous problem for me at the time. because it was, it was almost 10% of what I make. So it was crazy, right? So if it hasn't happened to you, it's really only a matter of time. So this phantom tax problem is not so much of a phantom. It's not a fluke. It's the structure of how the mutual funds are designed. When mutual fund investors decide to sell their shares, the fund manager often has to sell the underlying securities to raise cash to pay those departing investors, right? So if those securities have appreciated in value, that sale triggers a capital gain. Here's the painful part. That capital gain is distributed to all remaining shareholders, including you, even if you didn't sell a single share. So that's why I had, I don't know, I think it was like almost 35% of the value of the mutual fund got kicked out to me in capital gains. That was a lot. So Dan Soderoff, an associate director of passive strategies research at Morningstar, explained it clearly in a recent interview. Mutual fund investors have less control over when they realize capital gains. The behavior of your fellow investors can literally determine your tax bill. So financial experts have a phrase for this. It's called the phantom tax. You didn't make any decisions to sell. You didn't benefit from the gain in a way you can spend, but you owe the taxes. Now let's look at the numbers because they are striking. 2025 data, 52% versus 7%. Okay. State Street Global Advisors, one of the largest asset managers in the world, released a detailed analysis of 2025 capital gains distribution. Here is what they found. ETFs paid a capital gain in 2025 were 7%. So 70% of the ETFs made their clients pay a capital gain. How many mutual funds in 2025? 52%. So let that sink in. More than half of all mutual funds distributed capital gains to their investors last year. Less than 1 in 10 ETFs did the same thing. Bring it down even further for equity funds specifically. Equity ETFs distribute capital gains in 2025, 6%. Equity mutual funds distributing capital gains in 2025, 57%. So, so this is a really stark representation of what's going on. So, roughly 72% of U.S. equity mutual funds issued capital gains distributions, with average payouts ranging from 7 to 10% of the fund's net asset value. That's a lot. It can be a lot of money, right? Morningstar's editorial director for financial advisors, Cheryl Rowling, made a statement that I want you to hear clearly. In 2026, the ETF isn't just a trading vehicle, it is a tax management technology. So, the 2022 down year, cautionary tale. So here's something even more alarming. What happens in a bad market year? In 2022, the S&P 500 declined by more than 18%. A painful year for investors, and yet 2/3 of all U.S. equity mutual funds still distributed capital gains that year, averaging 7% of their net asset value. That's 2/3. Think about it. Your account was down, the market was down, but you still got a tax bill. So Morningstar calls this a fundamental flaw in the mutual fund structure. Investors are forced to pay taxes on a losing investment. The ETF structure, by its design, sidesteps this problem entirely. How do you avoid the problem? How do ETFs avoid the problem, I should say? It's called in-kind redemption. So how do ETFs do it? How do they avoid triggering capital gain distributions? The answer lies in a mechanism called in-kind redemption. When large institutional investors, called authorized participants, want to redeem ETF shares, they don't receive cash. Instead, they receive a basket of the underlying securities. That exchange, securities for securities, does not trigger a taxable event for the fund. No securities are sold, no cash changes hands, no gains are realized. So BlackRock, the parent company of iShares, also is the manager of thrift savings plan for federal and military personnel, reported that despite holding 30% of all U.S. managed fund assets, ETFs accounted for just 1% of the fund industry's total capital gains distribution in 2025, 1%, while holding 30% of the assets. So, 30%, but only contributed 1% of the capital gains. So, as Kathy Keller at Vanguard put it, ETF investors will still have to pay capital gains taxes when eventually they sell their shares. The ETF isn't a permanent tax shelter. The advantage is that ETF investors can choose when to realize those gains, while mutual fund investors have far less control over that timing. So, what does that mean in real dollars? The Brookings Institute study published that last month modeled the long-term impact of this tax difference on a real investor. It looked at two hypothetical funds, one a mutual fund, one an ETF. Both tracked the same S&P 500 index with identical holdings. The only difference was structure. Starting with $10,000 in 2010 and tracking through 2025, here's what they found. The ETF account balance grew approximately by $61,000. That's how much it grew. The mutual fund account balance grew to approximately $49,000. That's a gap of nearly 25% on the exact same underlying investment. So the research quantified the actual tax advantage of the ETF structure at approximately 1.05% per year. May sound modest, but compounded over a 20-year retirement savings horizon, that's a difference of, 1.05% annually, and can translate into tens of thousands of additional dollars in your portfolio. A financial analysis of the top 10 growth funds found even more dramatic numbers. The average tax drag on growth on an ETF was 0.39%. For the comparable mutual funds, the tax drag ballooned. I can say that out loud. The tax drag ballooned to 6.69%. That's a big difference that you can really feel, right? So a full over 6% difference, and how much the taxes dragged on the funds, right? So we just walked through a bunch of data. 52% of mutual funds send their investors a tax bill they didn't agree to. ETFs, just 7%. That's a gap. That's not an accident. It's structural. It compounds every year. So if you have an unqualified account or an individual account, or what do they call a personal account with a mutual fund company, you might want to consider looking at ETFs. So whether this affects you depends entirely how your specific accounts are structured, right? So like a qualified financial advisor can help you look at your holdings, identify where unnecessary tax drag may be occurring, help you build a more efficient plan without disrupting your investment strategy. At Nolan Financial Partners, we do this a lot. We are not tax attorneys or CPAs, but how your funds are invested have tax implications. Our complimentary consultation is your first step toward a portfolio that works harder and keeps more of what it earns. Call us 719-210-4242. That's 719-210-4242. Visit us at NolanFinancialPartners.com today. Okay, so now I want to make sure we're being completely fair here. There's an important asterisk on everything we've discussed about tax efficiency. The ETF tax advantage we've been talking about is taxable account advantage. If your investment lives inside a 401k, traditional IRA, or Roth IRA, the tax picture changes dramatically. Here's why. Inside a tax-deferred account like a 401k, traditional IRA, capital gains distributions don't trigger a tax bill at all. They remain sheltered inside that account until you make withdrawals. At that point, you'll pay income tax on what you take out, regardless of whether it came from an ETF or a mutual fund. So inside a Roth IRA, capital gain distributions they don't create a current year tax bill. And if you follow rules, they're never taxed at all. So if you're primarily inside a tax advantage retirement account, the ETF structural advantage we've been talking about becomes a lot less relevant. The phantom tax problem essentially disappears inside a 401k, right? So, the 401k reality is mutual funds often make a lot of sense in 401k accounts. They are well suited for automatic contributions, the kind that come out of your paycheck every few weeks. You can invest it at whatever price the fund is offering that day. You can buy fractional shares. You can set up systematic investing with precision. Those are real advantages. However, ETFs are changing rapidly, right? There's more and more of them. So there are more access to them, and there's more access to how you get your money into them than ever before. So, but this is why most 401k plans are built around mutual funds, and they have mutual fund companies like Fidelity and BlackRock and Vanguard managing those because of that automated contribution functionality. And for that purpose, mutual funds remain highly functional and appropriate vehicles. Now, there's a taxable account reality. So the equation changes in your taxable brokerage account or your taxable account at a registered investment advisory like ourselves. So if you have investments outside of your retirement accounts and a regular account in the market, a joint account, a trust, that is where the ETF tax advantage becomes genuinely compelling. In those accounts, every capital gains distribution is a current year taxable event. The phantom tax problem is real and recurring. And over 10 to 20 or 30 years of investing, that recurring drag, which we know now can be as large as 6% annually for equity mutual funds, a significant headwind to wealth accumulation. For those accounts, the Morningstar and Brookings data we discussed today makes a strong case for the ETF structure. So what about expense ratios? Here's one more dimension to talk about. What is the cost of investing in an ETF versus a mutual fund? ETFs have historically offered lower expense ratios than actively managed mutual funds. Average expense ratios have fallen for both vehicles in recent years, but even a small difference in fees compound meaningfully over time. Western and Southern's recent analysis noted that a 0.3 percentage point difference in expense ratio can translate to a lot of money over if you've got a long period, a long horizon. So if you got a 30-year horizon, can mean some real money. So for a passive index investor, you want broad market exposure without paying active stock selection. Low-cost index ETF may be a good choice. Maybe it's it's just a better way sometimes of being exposed in the market, right? So the combination of low fees and the tax efficiency is hard to argue with on a taxable account. So that said, not all ETFs are equally tax efficient, like emerging market ETFs and leverage and inverse ETFs and commodity ETFs and structural limitations to reduce their tax advantages. This is not a one-size-fits-all decision, which is exactly why having a qualified advisor view what your specific holdings are matters. So first, how much of your portfolio lives in taxable accounts? And is it structured to minimize unnecessary capital gains distributions? Second, are your retirement accounts and taxable accounts working together in a tax-efficient strategy, or are they operating independently without a coordinated plan? These are exactly the kind of questions we get to answer here at Nolan Financial Partners. We look at your complete financial picture, what you own, where it's held, how it's taxed. We build a coherent strategy that keeps more of your money working for you. Reach out today for a complimentary no obligation appointment. Call 719-210-4242 or visit us at NolanFinancialPartners.com. We serve Colorado Springs and surrounding area. We'd love to meet you. Okay. Let's zoom out for a little bit because the data we've been discussing isn't just interesting, it's reshaping the entire industry. And understanding that shift can help you make better decisions. The movement from mutual funds to ETF has been substantial, right? So $1.5 million is how much ETFs gained last year. 692 billion left mutual funds. Those are real numbers. So it's not just an individual investors, it's financial advisors are moving in the same direction. We've recently added ETFs as a more modern vehicle for people. It's something that we feel is important. So one of the most significant develops in 2025 and 2026 has been the rise of active ETFs, exchange traded funds that are actively managed, just like traditional just like traditional mutual funds. So, but we wrap them in a tax efficient ETF structure, right? So this is important because one traditional argument for keeping money in mutual funds was that the active management required the mutual fund structure. That argument is no longer valid. So the 2025 data shows that just 9% of active ETFs issued a capital gain compared to 53% of active mutual funds. So here's a particularly painful statistic for active mutual investors. Nearly 1/3 of active mutual funds both underperformed the market and paid a capital gain distribution last year. They give you below market returns and then send you a tax bill. That's, by contrast, just 2% of active ETFs underperformed and distributed a capital gain in the same period. So active ETF structure is pretty young, but it's maturing rapidly. If you're interested in finding out more about that, please give me a call. So it's worth noting that leading in this transition, research shows that high net worth investors, those with the most to lose from tax drag, have already made a significant move. Nearly half of their investable assets are now held in ETFs. This is not a coincidence. When you have a substantial assets in your taxable accounts, a 1% annual tax efficiency, that average is worth real money. So wealthy investors have access to this more sophisticated financial advice, and that advice has increasingly pointed toward ETFs for taxable accounts. The opportunity for everyday investors is to apply those same principles to their own portfolios without the guidance of a knowledgeable advisor. So what this means for retirement planning, I want to connect this ETF discussion to the broader retirement picture. So the location of your assets, where should they be? How are they taxed? How is it actively managed? Is it just managed on a set of rules that have no personal person involved at all? These are things you should know so that you can get the most out of your money. So in conclusion, we started with the number today, 52. That was the percentage of mutual funds that sent their investors a capital gains distribution last year, whether those investors made any decision or not. And today, with a different number, yours, your tax rate, your account structure, your timeline, your retirement goal. Those are the numbers that matter most. And they're the numbers that a good financial advisor help you understand, plan around, and optimize. So thank you for joining me here on Nolan Financial Radio. I'm Chris McKinney. And remember, the best financial decisions are the informed ones. Give us a call at 719-210-4242, and we'll set up that complimentary consultation.